something like maybe that we're headed for one is bigger and bigger calls are from more and more mainstream outlets that gold is going to 3,000, that kind of thing. We've actually seen that in the last few days a little bit. Now, I saw just today that Citi is calling for $40 silver in the medium term. That's pretty bullish from, your kind of mainstream investment bank. Silver is quite highly valued in the near term, meaning that it doesn't have much upside in their view in the near term. And so they as well are quite cautious. Similar action in gold.
Gold has experienced a significant surge in value over the past several months, with prices rising by hundreds of dollars. Since the beginning of the year, the price of gold has increased by approximately 30%, marking one of the strongest periods for this precious metal in recent history. This week, the market witnessed a record high for gold, with prices climbing an impressive $145 in the last month alone. Compared to last year, gold has surged over $740, capturing the attention of investors and analysts alike. Despite this remarkable growth, market experts are advising a cautious approach. Many analysts anticipate that a consolidation phase may be on the horizon, where prices stabilize or even experience minor declines. Peter Krauth, a noted expert on precious metals and author of The Great Silver Bull, notes that such corrections are normal and should not alarm investors. These market fluctuations reflect the natural ebb and flow of sentiment, emphasizing the importance of patience for those holding gold positions. Recently, mainstream financial institutions have historically maintained a cautious stance toward precious metals and presented notably bullish forecasts. Analysts predict that gold prices could surpass $3,000 per ounce by mid-2025. Akash Doshi, head of Citigroup Research's North American Commodities Department, has stated that gold may reach $2,600 by the end of 2024, while silver is projected to rise to approximately $40 per ounce. This shift in market sentiment mirrors past growth periods in the precious metals sector, particularly the silver rally in 2011. Back then, silver prices surged to nearly $50 per ounce, driven by economic uncertainty, robust industrial demand, and rising inflation concerns. However, Peter Krauth warns that such high expectations can create market volatility. Commercial hedgers are taking notable short positions in gold and silver, indicating they anticipate potential declines. While the long-term outlook for these metals remains strong due to ongoing economic challenges, a period of consolidation may be on the horizon. We will present clips from Peter Krauth's interview. But before we do, if you want more videos like this, please hit the subscribe button and turn on the notification bell for more updates.
I think something like maybe that we're headed for one is bigger and bigger calls are from more and more mainstream outlets that gold is going to 3,000, that kind of thing. We've actually seen that in the last few days a little bit. Now, I saw just today that Citi is calling for $40 silver in the medium term. That's pretty bullish from, your kind of mainstream investment bank. And I can't remember who, but there were some calls from some of the larger banks as well, U.S. banks, for us to head towards $3,000 gold. Remember, these have been sort of the least sort of strong precious metals advocates you can imagine for the last decade or two, and now we're hearing calls for these metals to go considerably higher. So to me, that adds to my outlook in the very near term to be cautious. And again, I'm not here to kind of rain on anybody's parade. If there's anyone who's a bull in silver and in gold, that's me. But I do think that near term, it's wise to be cautious. And I've seen other analysts that I'm very hold in a very high regard, and they're starting now to say very similar things. So I feel like I'm in good company that way. I still think we're the minority, but it's the contrarians that tend to over longer term, do better. So another sort of reason to be cautious here, I think. One of the other signs that I had mentioned was if you look at the positioning in the futures markets, there are speculators, and then there are what we call commercial hedgers. And the commercial hedgers are really considered the smart money. These are the big investment banks, some large producers. And so they will position themselves either for higher or for lower silver, obviously depending on their outlook. But because they deal with such large numbers, values in terms of exposure to silver, and they have these are professionals that do this, as their jobs, and with lots of responsibility. And because of that, they, as I say, they tend to be on the right side of things. And their positioning in silver futures is actually at quite a low level right now, on the long side. So they are, I believe it's net short right now, and it's a pretty high net short position. So they feel that silver is quite highly valued in the near term, meaning that it doesn't have much upside in their view in the near term. And so they as well are quite cautious. Similar action in gold. And so, you have these indications, as I say, from what we call smart money, that it's getting a little rich at this point. It's been a pretty relentless rise. And they just look at probabilities, and the odds in their view favors, like I say, I think a consolidation over the next short while. Maybe we're talking a matter of weeks or maybe even a month or so. And so, yeah, as I say, they're positioning for that.
Recently, significant attention has turned to the Federal Reserve's decision to cut interest rates in light of declining inflation figures. This rate cut, the Fed's first since 2020, represents a crucial shift in its monetary policy approach. Members of the Fed's rate-setting committee anticipate an additional half-point reduction in borrowing costs this year, followed by a further full-point decrease next year, outpacing earlier forecasts made just 3 months ago. This change marks a pivotal moment in the Fed's 2.5-year campaign to manage inflation. Since March 2022, the central bank has raised rates substantially, peaking between 5.25% and 5.5% last summer, the highest level over 2 decades. However, some analysts argue that inflation is becoming a more structural issue, suggesting that the challenge is far from resolved. Peter's analysis parallels the inflationary environment of the 1970s, indicating that we may face similar waves of inflation. The U.S. economy encountered significant challenges during that time, including oil crises and evolving monetary policies. Central banks responded by temporarily raising interest rates to combat rising inflation, yet they often encountered renewed price pressures. In light of these historical patterns, Peter suggests that traditional investment strategies may struggle, while commodities, particularly precious metals, could emerge as more resilient options in the current landscape.
I did talk about that recently. In a recent presentation, I looked at where inflation was, if you go back, let's say from the great financial crisis, so 2008 or so, up until right around the time of COVID or a year after that. And that was really about 2%. And I clearly remember the Fed and other central banks being sort of antsy and anxious about trying to get inflation up. Their worst nemesis is lack of inflation or deflation. They say they don't want inflation too high, but they certainly don't want deflation. We just have to look at the kinds of things that Bernanke has said in the past about the Great Depression and so on. And so post-financial crisis, as I say, until around the time of COVID, was averaged right around 2%. But since COVID and the massive printing that we've seen, there are some things that look like they're becoming embedded now. We've got things like the ability for labor to command higher wages. We're looking at certainly we can pretty much agree that COVID triggered the end to some forms of globalization. Supply chain management really now is looking at sourcing things much more closer. Anything that's sort of vital or critical, they want to have options to be able to source these kinds of things much more closely, closer to home. You've got the energy transition. This has become sort of widely accepted, embedded, mandated, etc. And then the fourth item is defense spending. And, in the last couple of years, we have, sadly, it seems like more and more wars are breaking out, and they don't seem to be ending anytime soon either. There's more and more mistrust, partly as well, I think, related to COVID. And so these are all things: labor, end of globalization, energy transition, defense spending. These are things that are all sort of layering on top of where we were of 2% inflation. And I think they probably add up to somewhere around an additional 2%. So I think we're at a level where we're going to see an average of structural inflation much closer to 4 or 4.5%. I think, I've said a few times, I think 3% is the new 2%. And frankly, I think it's actually higher than that. So these things, as I say, they're becoming embedded, and it's going to be a real challenge. If you look at what happened in the 70s, we had successive waves of inflation. So what would happen was you got that first wave in the late 60s, early 70s. The central banks would step in, raise rates, and that would calm things for a while, which is what we're experiencing now. So it's very easy to relate and understand that. But what happened was, naturally, they didn't raise rates and keep them up. They started to back off and start cutting, which is, again, what we're doing now. Well, interestingly enough, if you look at that very first wave in the 70s, by the time, once it bottomed, it only took about 12 months for inflation to start climbing back up again in a very meaningful way. And we ended up at inflation that peaked above the first wave. So frankly, I think that's what we're in for this time as well. We're going to get successive waves of inflation, and it's going to be very challenging. And we know from the 70s that the 60-40 portfolio really had a tough time. In fact, the entire decade of the 70s, it had a net real return of minus 3% annually. The S&P and the Dow were flat for a year without accounting for inflation. So I think that's sadly the kind of outlook that there is. And so commodities did extremely well. People really need to look at that closely and factor in at least some sort of allocation to the commodities sector, and especially the precious metals.
The anticipated Federal Reserve rate cuts in 2024 will likely boost gold and silver prices. ANZ Research forecasts silver could reach between $31 and $33.80 per ounce by year-end, with an average of $28.90 for the year, driven by a supply deficit and rising investment demand. Trading Economics estimates silver will hit around $29.56 in Q3, climbing to $30.28 in Q4. JP Morgan expects silver to approach $30 per ounce, fueled by gold's momentum and declining U.S. real yields. Given Peter Krauth's insights, do you believe gold and silver prices will continue to rise shortly? Let us know in the comments section below. Also, ensure you like this video, subscribe to the channel, and turn on post notifications for more videos like this. Until next time.